Hi everybody, this is Lara with your weekly video for the S&P 500 for the week ending Friday 23rd of December. Merry Christmas for everybody for Sunday. I hope everyone has a really lovely day and I hope you're able to all be with your families. Elliott wave analysis first, classic analysis last. I'm expecting a little bounce to end. Midterm target for downward movement 3267, long-term target 3144. At the weekly chart level, my wave count sees a cycle degree fourth wave over there and a cycle degree fifth wave continuing higher. At super cycle degree, and to see this you have to look at my grand super cycle analysis. I'm just going to quickly go back here. I link back to that every week at the start of this analysis, so if you haven't already viewed that, grand super cycle analysis is here. Monthly charts last updated there, and I'll do those once every couple of months. I'm expecting that super cycle waves 1 and 3, according to my grand super cycle analysis, were quite long extensions. So if cycle 5 is to continue not for too long, then I expect that means super cycle 5 may not be extended overall. It would be a bit short if cycle 5 were to be over here, and there's not enough technical evidence of that, but I have an alternate wave count looking at that idea. So someone asked a question about expecting super cycle 5 to end beyond 2029, to take much longer, and the reason why I wouldn't expect that is it would be too long. It shouldn't be extended, so that's why I'm outlining that. I expect cycle 5 is unfolding as an impulse with primary 1 complete, primary 2 continuing lower as a zigzag. When it's done, there'll be 3, 4 and 5. Primary 2 may not move beyond the start of 1 below 2191.86. The target for it remains the same for intermediate C to reach equality in length with intermediate A at 3144. Primary 2 unfolding as a zigzag, that's the most common corrective structure, particularly for a second wave, and they are labelled A, B, C, and zigzag subdivide 5, 3, 5. The wave A at intermediate degree looks like a pretty good 5-wave structure. 1, expanded flat for 2, 3, 4, 5. B looks like a zigzag. Intermediate C needs to be a 5-wave structure. 1 looks like an impulse. 2 looks like a correction. 3, 4, 5 is required to move lower to complete the structure of primary 2. Minor 3 must make a new low below the end of 1. When it's complete, minor 4, a correction or bounce, may not move into wave 1 price territory, and eventually minor 5 usually moves beyond the end of 3 to avoid a truncation. When I have the ends of minor 3 and 4 and I know where minor 5 starts, then I can add to this target calculation at minor degree. At that stage, it may widen to a small zone or it may change. This channel is really important, and this upper edge now has 4, if we count the start, 5 tests. 1, 2, 3, 4, 5. Possibly even 6 if you count this week. And so this upper trend line now has some pretty reasonable technical significance. The lower trend line has 1 and nearly a test here, and so this may show where intermediate C comes to find support. This channel is drawn using Elliott's technique for a correction. You draw a corrective channel from the start of A to the end of B, and place a parallel copy on the end of A. Look for C to find support or maybe to overshoot the lower edge. Sometimes C waves can be quite strong because they are in a third position, so they can have a little bit of third wave tendencies sometimes, not always. Let's take a look at the daily chart where the low of minor wave 1 is this point down here. Minor wave 2 subdivides as a double zigzag. A little bit difficult to see a single zigzag in this, but a double zigzag fits. Although Y has moved only slightly beyond the end of W, barely deepening the correction, not really achieving its purpose, but this is how the subdivisions fit. And just FYI, subminuet 4 in here on the hourly chart is a triangle, so that's why it's ending here and not here. If minor 2 is over here, then minor 3 should have begun. This is a third wave within a C wave, so it could be quite strong, particularly toward the middle. Minor 3 may only subdivide as an impulse within it. Minute 1 may be over here. Minute 2 may be an incomplete expanded flat. If it's high enough next week and moves beyond my target, it may find resistance for another test of the upper edge of this trend line, and this trend line isn't perfectly showing where those tests are finding resistance. A little bit of an overshoot here and a tiny overshoot here. So if price does get up there again, don't expect it to behave perfectly, but we'll look to how it behaves around this trend line. Minute 2 may not move beyond the start of 1 above 4100.96. Now I may need to move the degree of labeling here down 1 degree. Minute 1 may not be over. This could just be minuet 1 and 2. The invalidation point's the same, the expected direction is the same. That's a problem for the next week or two. So just so you're aware, I may have to change the degree of labeling. That's one of the hardest things early on in a new movement, to try and figure out what is the correct degree of labeling. The target for minor 3 remains the same. It'll reach equality in length with 1 at 3267. That's the ratio I'm using because it works with the lower target for intermediate C. At the daily chart level, if we move the degree within intermediate C or up 1 degree, then it's possible to see that primary 2 could have been over here. There is not enough support from classic technical analysis though to suspect or to have confidence that the bear market's over and a third wave at primary degree began back down here. But we need to consider alternates. What if the main count's wrong? Yes, this is possible. It has an okay fit. Within primary 3, intermediate 1 could be over here, intermediate 2 could be over, or it could continue lower. It may not move beyond the start of 1 below 3491.58. The target for primary 3 is for it to reach 1.618, the length of primary 1 at 7742, a common ratio, particularly for the S&P, for a third wave. And if this target's wrong, it'll be too conservative. The S&P tends to have extended third waves. It's extremely common, almost always. Not always, but almost. If we move the degree of labeling within cycle 5 up 1 degree, it's possible that cycle 5 could be over, which means super cycle 5 and grand super cycle 1 could all be over. This, if my grand super cycle analysis is correct, and again, I link back to that at the start of the every week's analysis and every day's analysis for you. If that's correct, this could be a trend change once in multi-generations, a bear market to be absolutely devastating, to last over a decade, possibly even 20 years or more, still in its first year and a bit. So this is a very, very bearish wave count. Now there's a touch of support, a reasonable amount of support from the NASDAQ AD line making new lows below March 2009. And the bond market is still in a strong bear market. I'll be watching that one closely. If the bond market starts to turn up and makes a new swing high from the bear market and breaks that series of lower lows and lower highs, then I may discard or stop publishing this wave count. But I'm publishing it mostly because of NASDAQ AD line and the bond market. So there's a bit of evidence for this. However, at the all-time high, there was only 2 months of bearish divergence between price and the NYSE All Issues AD line. In the last 100 years, there have only been 4 bear markets that have eventuated after less than 3 months bearish divergence between the NYSE All Issues AD line and the S&P 500. 1946, 1976, the COVID crash, and this one, this current bear market. And there is a statistically significant positive correlation between the length of divergence and the severity of the following bear market. A short divergence is positively correlated with a more shallow bear market. And so there was only 2 months of divergence back here. That's positively correlated with a more shallow bear market. This very bearish wave count, expecting a huge bear market, doesn't have support from that piece of technical analysis. So it has a low probability. I wanted to publish it to show you what it looks like. We need to be aware of possibilities. If we see a new low below 2191.86, this would be my only wave count. That's what it needs for confidence. Now that is a long way away, but for such an absolutely enormous bear market, it's actually not that far away in the grand scheme of things. This week has completed almost a doji, a small body with a longish lower wick, so we may get a little bounce next week following that longish lower wick. That would support the short-term outlook for the Elliott wave count. A decline in volume not a very strong downward week, but the previous week was quite strong with that bearish upper wick. This week, a further decline in volume. Price is essentially falling of its own weight. It can do that for quite a while. I need to change that to say resistance. Look for resistance now, about 3,950. Next support below quite strong, about 3,600. As price is falling, on balance volume is moving lower, and it's essentially equal with previous lows back down here, but price is quite a long way off. This is bearish from on balance volume. This supports a bearish Elliott wave count. ADX is declining. There's no clear trend at the weekly chart level. RSI, money flow, stochastics, all neutral. Stochastics barely touched overbought. Price reaches resistance, so I'd expect a downward swing and to see stochastics move into oversold after that bounce. The daily chart sees Friday complete with an inside candlestick, mostly upward movement as the session closes green, a real lack of volume, a really quiet end to the week, but hey, that's to be expected considering Christmas. We may get a further bounce next week to test resistance at the lower edge of this rectangle, and the target from the rectangle, 3729, still hasn't been met, so that's still in play. So, and support around about that area, just a bit below at 3720. On balance volume made new lows prior to price at the daily chart level. This is also bearish. A little bit of sideways movement to end the week. Really weak volume as you'd expect for the holiday week. RSI neutral, money flow neutral, stochastics returning to neutral, and ATR increasing as price moves lower, essentially moving sideways now as price moves sideways. This week prices moved lower. The NYSE All Issues AD line also moved a little bit lower. No new divergence. There's no divergence here that needs to be resolved. It's the breadth is pretty much in line with price. Price and breadth still are both of them a little bit of a ways off lows for the NYSE All Issues AD line. And for the short term, an upward session an inside session for Friday, upward movement dominating, breadth improving slightly, a bit of support there, but no new divergence. Between price and the NASDAQ AD line, though, it's quite spectacularly in a huge downward movement, making new lows below March 2009. It's done that before, though, and that doesn't mean that a huge bear market has to arrive. It's more spectacular this time, though, and this is one reason why I published that very bearish wave count. But we really would need more evidence for such a huge bearish movement than this and the bond market. We need to consider it, but it's not enough. I judge it still to have about 10%. NASDAQ AD line has also made new lows below March 2020, the COVID lows. Price hasn't, so there's also this divergence as well, which we can see better on this time frame, the weekly chart level. It's just off to the left of the chart now. This week, both NASDAQ AD line and price moving lower. NASDAQ AD line almost pretty much in line with prior lows. Price is a little ways off, so again, NASDAQ AD line is more bearish. It does have a bearish bias, though, the tech sector, particularly in a bear market. Inverted VIX moving higher this week, price moving lower 2 weeks in a row. Inverted VIX has been behaving really strangely with this bear market, which leads me to believe it possibly is going to be more shallow than deep, because it's just volatility is not increasing along with price. There's quite a cluster of bullish divergence here now, and this may develop further as the bear market comes to an end. For the last 2 weeks, inverted VIX has moved higher, price has moved lower. Normal increasing volatility is not happening with this decline in price for the last couple of weeks. VIX and VVIX both declining. At the daily chart level, price moved higher within the session and inside session closing green, and inverted VIX moves higher, no new divergence. VIX and VVIX both moving lower on Friday, no new short-term divergence. That's it for December. Almost from me with your S&P analysis. And again, a very, very Merry Christmas to everyone, and I thank you so much for your support.